Welcome to the BISP solutions. So our today's topic is consolidation of the financial statements. So what does consolidation means? Consolidation means grouping of the financial statements of the group companies. Group companies means holding company, subsidiary, associates and joint ventures. Now, what is holding company and what is subsidiary company? Holding company is means a company which enjoys control over the other companies. Now, what is subsidiary company? It means a company in which holding company controls or holds more than 50% of the total share capital. That means if the parent company, when it owns a significant stake in another company, the later company is called the subsidiary company. Now, what are the consolidated financial statements? These are the financial statement of a group in which assets, liabilities, equity, income, expenses and cash flows of the holding and its subsidiaries are presented as those of a single economic entity. In simple words, the accounts of the different companies belonging to the same management or owners are consolidated to present the financial position of a group as a whole. In short, it means, as we know that holding and subsidiary company are separate entities. Yeah, so but they both work as a group. Therefore, the users of the holding company needs the financial information of the subsidiaries. Why? In order to understand the performance and financial position of the holding as well as the group. That's why we are preparing the consolidated financial statement. In short, it means the aggregated reporting of their entire business collectively. Okay, now we'll see the consolidation procedure means how we do the consolidation. First, in preparing CFS, the financial statement of the parent and the subsidiaries should be combined on line by line basis. That is by adding the like items of assets, liabilities, incomes, and expenses. Simply, we'll add all the assets, liabilities, income, and expense of both the companies, that is holding and subsidiaries. Secondly, what is to be eliminated, we'll see that the parent company's investment in the subsidiaries, it will not be included in the consolidated financial statements. Means the investment which the holding company is done is to be eliminated in consolidated financial statement. Third, if the cost of investment in subsidiary exceeds the parent portion of the above equity on the date of the consolidation, the excess is debited in the goodwill and should be shown as an asset in the CFS. That means if the amount of investment is more than what we have received, that is a net asset. So the difference is the goodwill and it is shown as an asset in CFS. Means we are paying more than what we have received. So why we are paying more? For the amount of the goodwill. For the goodwill. That's why. And vice versa is the case. If the investment done is less than what we have received, the difference is the capital reserve and it is shown under the reserves and surplus. That is C. If the cost of investment in subsidiary is less than the parent's portion of above equity on the date of consolidation, the difference is credited to capital reserve account and should be shown in the CFS under the head reserves and surplus. Okay, now we'll calculate the minority interest. Minority interest is also known as the non-controlling interest. It means a share in the subsidiary company owned by party other than the holding company. Yeah, so it is to be calculated. It is also shown in CFS under equity side. That is after reserves and surplus. Yeah. So if there are any intergroup transactions or balances or incomes, that also will be removed from the consolidated financial statements. Okay, now we'll see one example. Moon Limited has owned 80% shares of the Light Limited. Moon Limited is the holding company and Light Limited is the subsidiary company. Moon Limited has owned 80% shares of the Light Limited. Below, there are the statements of the financial positions of both Moon and Light Limited as at 31st December 2018. Prepare the consolidated financial statement of the Moon Group as at 31st December 2018. Yeah, so we have been given both balance sheets of both the companies, that is holding and subsidiary, equity side, share capital and retained earnings. So as we can see, Moon Limited holding companies share capital is 8 lakh and retained earning is 2 lakh, and Similarly, share capital of subsidiary companies 5 lakh and retained earnings are 1 lakh. As we can see, current liabilities, trade payable is given. Here the trade payable of Light Limited 8,000, that means 8,000 to be paid to the Moon Limited. That is a liability for the Light Limited. Yeah. Similarly, it's a trade payable for Light, and similarly will be the trade receivables for the Moon Limited. See, trade receivables 8,000. It is for the Moon Limited, that is holding company. Trade payable for the Light and trade receivable for the Moon. So it's intra-group transactions, and we have seen that the intra-group transactions are to be eliminated. Yeah, we'll see how. Other payables are 5 lakh and 1 lakh 92,000. Total is 6 lakh 92,000. Yeah. And asset side, non-current assets, PP it is given 2 lakh 50,000 and 1 lakh 50,000. Investment in Light Limited is 7 lakh. Current asset inventories 50,000 50,000. We have seen the trade receivables 8,000. Other receivables of 3 lakh and 2 lakh. Cash and cash equivalents 1 lakh 92,000 and 4 lakh. Now we'll see how to do the consolidation. Firstly, we'll add the line by line items. Yeah, step 1 is combine. So we have just added all the items. 8 lakh plus 5 lakh 13 lakh. 2 plus 1 is 3 lakh 8,000. 5 lakh 1 lakh 92,000. 6 lakh 92,000. So first step is we have just added all the items. Secondly, we will eliminate the items which will not be coming in the intergroup consolidated. So share capital and the retained earnings of the Light Limited, it will be eliminated as it will not be coming in CFS. So we have eliminated it. And the investment made by the Moon Limited, it will also not be coming. So 7 lakh, we have eliminated it. Yeah. Third step, we'll eliminate the intra-group transactions. As we have seen, 8,000 trade payable for Light Limited, and similarly 8,000 was the 8,000 trade receivables for the Moon Limited. So we'll eliminate it is trade payable for the Light and trade receivable for the Moon. So intra-group. So we'll eliminate it. Yeah. Now we'll calculate the minority interest. Yeah, no, that is a non-controlling interest. It comes on the equity. How we'll calculate? We have seen holding company Moon Limited holds 80% share, so 20% is a minority interest. Yeah, so and the equity portion of the subsidiary company is 5 lakh share capital and retained earning 1 lakh. So total is 6 lakh. 6 lakh. See, net assets of the Light Limited is, we have calculated through equity, 6 lakh into share of non-controlling interest is 20%. So it is 1 lakh 20,000 is the non-controlling interest, and it comes here 1 lakh 20,000. 1 lakh 20,000 is the non-controlling interest. Yeah. Okay. Now we'll calculate the goodwill. As we have seen, investment amount. See, investment is 7 lakh. Yeah. So investment minus net asset we have to do. Investment amount is, we have invested 7 lakh rupee, and what we have received 4 lakh 80,000. How does it comes? Share capital plus retained earning. It was of 6 lakh. 6 lakh into 80% share of holding. So it comes to 4 lakh 80,000. We have paid 7 lakh and we have received 4 lakh 80,000. So why we have paid more? 2 lakh 20,000 we have paid more. For what? For goodwill. And it is an asset for the company. So investment is like a goodwill. Goodwill, it's shown under working note to goodwill 2 lakh 20,000. It's an intangible asset, so it comes under asset side. Yeah. So we can see we have just added all the items. Share capital of the only holding company will come 8 lakh, 2 lakh of only of the retained earnings of only holding company. So we have taken that. Non-controlling interest we have just calculated. Trade payables, total of both other payables. 8,000 will not be coming. Why? Because we have seen intra-group transactions eliminated. So total is 18 lakh 12,000 of the liability side. Similarly, in asset side, we can see we'll just add all the assets. Yeah, we have added. Investment will not be coming, so we have taken 0. And goodwill we have calculated 2 lakh 20,000. Remaining items will just be added. And trade receivables, intra-group transaction, as we have seen, trade payable and trade receivable will not be coming, so we have taken 0. So total of the asset side is 18 lakh 12,000, and liabilities also 18 lakh 12,000. So this is how the consolidation is done. Thank you.